The Federal Reserve has a responsibility for stable prices, in other words, to control inflation. And after the last FOMC minutes, they've pretty much chosen not to do their one job. If you don't remember my previous history lesson, when they raise interest rates, it typically pops asset bubbles. In other words, it kind of crashes stock markets. How much and how fast is what matters, and they say they're raising it by 25 basis points with the caveat they may consider raising 50 basis points or more in a measured approach. Here, let me help you visualize what that would look like. Imagine a runaway train. Let's call this train inflation. Here's what a 25 basis point raise would look like. Basically, you accomplish nothing. Now, currently we're at 7.5%, the highest since 1982. Why is that significant? Because in the way they calculated before, they didn't add in substitutions. Now we added substitutions. And what it is basically, if beef is too expensive that month, then I'll switch to chicken. Well, what happens when you do that? Well, you're not calculating the inflation of the beef, you're actually just calculating the inflation of the chicken. So you could actually artificially have lower CPI numbers than you actually do. Therefore, that 7.5% inflation might actually be a higher number. Another interesting thing about the 1980s is Paul Volcker. He was just the Fed chair at the time with inflation nearing around 13%, and he had to raise interest rates like crazy. And by crazy, we're not talking about some limp-wristed 25 to 50 basis point move. We were already at 1,100 basis points, and they moved it to 2,000 basis points. But he's just some old crackpot. It was kind of weird. He was just trying to control the money supply rather than establish a specific interest rate or, basically just turning off the money printer. Fast forward to today when we have about 7.5% inflation, allegedly. And we also have a debt ceiling discussion, I think, in July. Does anybody think that raising the debt ceiling won't print more money? Or is that just me? If you don't see the consequences of money printer go burr and you're going to keep doing it even more, I don't think I can help you. All I could say is, like, subscribe, comment, share this video and stuff like that. And honestly, don't take my word for it. I'm not somebody that's an expert in this field. My macro really sucks. Take it from one half of someone who's lived through this and did some things. I don't know. He seems to be some kind of relative nobody, some old guy or whatever. But I'm signing off here. So just remember, just because you're a day trader doesn't mean you have to trade every single day. And enjoy the clip afterwards.
Inflation is a very serious subject. You can argue it's the way democracies die. When democracy dies in Latin America, inflation is a big part of it. So it's a huge danger once you've got a populace that learns it can vote itself money. If you overdo it too much, you ruin your civilization a lot. And so, of course, it's a big, long-range danger. If you look at the Roman Republic, and even after they went to an empire with an absolute ruler, they inflated the currency steadily for hundreds of years, and eventually the whole damn Roman Empire collapsed. So it's the biggest long-range danger we have, probably, apart from nuclear war.
Oh, wow, you guys. Inflation right after nuclear war.